Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
It's my birthday and I'll cry if I want to, cry if I want to. You heard me, it's my birthday and Don's making me work. But
For a change.
Don has me working, but he's a workaholic too. He works his butt off too. So we are doing the show early today, folks. Welcome to Your Money Radio. It's January 30th, my birthday. And
what number, Dan?
38.
Again?
Yeah. I die this
for the 22nd year?
I die this little gray to make me look a little more mature. I don't want to look too young.
Good thinking.
Yeah, anyway, so Don is going to be on IBD Live tomorrow morning. He's going to be their guest host. But I wanted Don on this show this week because we had that big AI tech rout on Monday, a big rout in tech stocks, and it kind of upended that whole sector. And remember, NVIDIA and all those big companies, they were really buoying up the market. So if that sector of the market goes, Katie, by the door, we could have a lot of problems. Anywho, so I got an awesome mailbag question. I'm going to go over that because that actually sets up the whole show, and it talks about our process and why it's so important. Now, the heart of the problem is longevity and the random equity returns, aka the sequence of returns. Okay, so. And the longevity means if you're living longer, you look the old plans, the old modern portfolio theory, people drank and smoked. They retired at 65, they drank and smoked, they were dead by 72, it worked. 60-40 was fine. But now people are living to 100, you got to plan for 95 or 100 now. That 6% is not enough for most people. They're going to have to work, they'll be Walmart greeter till they're 90. Okay? So how are you going to make equity-like returns, however, but not make them random and not get crushed every time? So sequence of returns is what makes your pie charts or us portfolio random. Let me repeat that. If you have a pie charts or us portfolio and asset allocation, your probabilities at the end are random. It could be $1 million. It could be $500,000. The range is huge. Okay, now, so going to the mailbag very quickly. Okay, one of the articles by Morgan Stanley is Morgan Stanley sees very normal returns for 2025. What are normal returns, and how does that help you pick any investments or do anything? That is absolutely worthless. The next article, your clients may live to 100. Don't use the 60-40 glide path. That's actually an important article. It's saying I'll save you the trouble. You don't have to read it. People are living longer. You got to make higher returns unless you want to work till you're 100. Okay, next. So again, how do you make equity-like returns without the huge drawdowns? So to gap or not to gap. Now, there's two reasons you want to do this. Number one, it doesn't scare you out of your strategy. But number two, and most important, your retirement is not random. You're at the higher end of the range. Okay? So now Monday's sell-off, was that a one-day wonder or was that something worse? I mean, we planned it like it could have been something worse, and then we got back aggressive again. Don will talk about that. But here's what I want to talk. So here were the other articles, not these ones that are just boilerplate. They send them out every week and they just redress them up and change the adverbs. It's the same damn article every week. Okay, those last two. Okay, now these are the ones that were this week. Okay, now regardless, it did expose the vulnerabilities of this market that we've been talking about. So one article headline, NVIDIA, $465 billion Deepseek rout is the largest in history. So NVIDIA lost $465 billion in one day. That's larger, way larger than most S&P 500 companies. Okay. Triple leverage NVIDIA. There's another triple leverage NVIDIA traders gut punched by a 52% one day loss. Okay. Those guys are just way out there gambling. They're, but there were there were a lot of can slim traders that take the 20-25% position sizes and they lost 15-20%. There were a lot of traders that got hit hard. That's why position sizing is important. Don's going to talk that. That's important. So not grow or turbo, both of our portfolios, we may be able to go down 5 or 8 or 10% in a drawdown bear market, 12 maybe, but you're not getting 20, 25, 30. That doesn't happen. Okay. Next article, stocks hit as chip makers see worse routes since 2020. Actually, it was 2021. Don corrected the article, but in any event, so how do you stay in with a parachute? So this is why this is important, okay? Because you need to understand the difference between a 6 or 7% return and a 9% or even low double-digit return. A 4% spread, you can be talking about years in retirement, years, okay? But that sequence of return will add more certainty for it. In other words, that pie charts, the range is much wider. Look, I gave you that example last week and the week before. I'm going to do it one more time. You take $500,000. Guy takes out 4% a year. He retires starts investing January 1st, 1969 for 25 years. Jack and Jill, his kids, get whatever's left. Okay? Takes out 4%, has $500,000. He's dead broke and homeless. Jack and Jill have to pay for his retirement community in 1991 because he's homeless 2 years, 3 years before he retires, right? Same scenario, but you take the returns in reverse order. So year one is the return on S&P 1993, then 1992, and then year 25 is 1969. In that scenario, Jack and Jill inherited $1.45 million. You can do the numbers yourself. You don't have to trust me. Those are real numbers. So if you have a pie charts or us portfolio, your retirement buy and hopium portfolio, buy and hope, is random. It's much bigger than they're telling you. So number one, you don't have to have a random portfolio. And number two, you don't have to take a big 35% drop and get the bejeebers scared out of you. You don't have to go change your underwear. So with that, I'm going to get to the mailbag. Now, this is one mailbag. It is a little bit long, but I'm going to hit the highlights. I'm going to try to do it quick, but it's very important. This is very important because this sets the stage for the show, okay? I appreciate always thinking ways to protect he is a client. He's a long-term client. He's also got a CPA background, all that kind of stuff. So he's a sharp guy. I appreciate always thinking ways to protect our wealth, improve your techniques. Always have a good handle controlling risk, individual positions, limiting percentages, single stocks, and also working into a position as technicals improves. It appears one risk always tough to control for any money manager is overnight gaps. Excuse my lack of knowledge, but it appears gaps account for a decent amount of daily movements. That's true. Assuming I am correct, big assumption, wondering if you ever thought of analysis of cost benefit of controlling the risk overnight gaps versus something like the following, okay? Actually, I've been doing that for years. It keeps me up at night, and I have done all this stuff that he's saying with that backdrop. Okay, setting a program, calculate each day overnight risk to each industry sector, concentration risk, sector concentration of the portfolio, and a calculation of the overall stock market risk, beta, which you already do. We actually do both. In case it hits the overall market, not just a sector. If portfolio risk exceeds X, then, look at this. And he's talking about buying puts. Buy some puts. And he said, buying long-dated, out-of-the-money puts on sector, purchasing the cost would be reasonable since it's what's moving up. See, he's thinking because it's upward moving, the puts are cheap. Not true. Anything that had what makes an option expensive is the volatility of the stock, because that increases the probability of being in the money both above or below. So it's just how volatile the stock is. It makes that's the main variable. So puts are, and people buy insurance, so puts are more expensive than calls. So it is kind of expensive in any event. I said, my comment, puts will be expensive. I'm not sure it'd be too hard to execute the cost to protect against the blacks. And if the cost to protect against black swans would distract from returns. I'm not sure if cheaper option versus limiting exposure to a sector technically strong exposure. Limited, he's saying you could limit it to times when you saw the risk. And then I'm saying, but then it wouldn't be a black swan. In other words, he's saying put the hedge on kind of when you need it and take it off when you don't. Well, then you're not hedged all the time. And black swan means it comes out of nowhere. So it seems the above average returns the past years, the risk has increased for a downward gap overnight for a black swan event. My comment, those are feelings and emotions. The market is actually acting great right now. Look, I'm scared too. I'm fully invested, but I'm scared to death. I think the market is high. I think that's my feelings, but I got to follow my rules. Because if I didn't follow my rules, I wouldn't have beat the S&P last year. I wouldn't have been up 25%. Okay? I wouldn't have done that. I'd have been up 12. That's why I need rules to get out of my own way. Anyway, we will be analyzing closely to see if there's a way to better minimize the damage, along with our independent data scientist who will also review position sizing, sector weightings, etc. We always have a data scientist backtest our data. You are correct. Overnight gaps are the one thing controlling is difficult to quantify. But you also have nice gap ups to the upside that nobody talks about. Again, it's about right tail risk, meaning letting the winners run, versus left tail risk. How do you minimize or put a stop under the left tail while letting the right tail run so it is uncapped, range bound? If you cap the top, you're going to get an indexed annuity, CD-ish, 6%-ish return. So you're not going to get a high enough return with those structured products. They tell you are, but they're structured to make 6 or 7%. Over the years, I've looked at using broad index index leaps puts for an ongoing hedge for a gap down, because stop losses do not protect a gap down. In fact, you can lock in a much larger loss. This is why you do not want to use hard stops, but rather alerts. If you're using hard stops, market makers are the market makers know where the stops are, and they rape retail investors all the time. All right. The problem is very difficult to manage. Not everyone can qualify for options. And when doing a large number of contracts, because we would be doing hundreds, the market makers, people that see it, start to move the price away from you, and you only get a partial fill, right? But here's the main thing, the cost of the insurance, because it costs about 3 to 5% a year. Well, you only need it every 5 or 6 years, 4 or 5 years. Well, now you're talking about 20% for 4 years. So it's probably better. And if it's a big enough black swan, the Fed's going to come in and step in. But gap downs are the hardest thing to manage. I agree. All right. Also, we've looked at pairs trades, sectors, not individual stocks, like he was mentioning, for the same reason above, suitability. So you'd short a weak sector and you'd be long the strong sectors to track closely enough for a partial hedge. By the way, when you are long short the weakest sector to offset the longs, when something happens, there's a flight to quality, a sector rotation into the defensive sector you shorted. Therefore, you get a double whammy and you get hit on both sides. That's why pairs trading is tricky, because when you get the pairs trade wrong on both sides, you get slaughtered. You get taken to the woodshed. All right. Think long-term capital with dozens of PhDs that shorted treasuries and long Russian bonds that caused the Asian contagion in 1998. By the way, it's a tougher situation to address. Short-term happens quickly overnight, and the only way is to pre-position with insurance, with the puts I was talking about. Stops are no good. In fact, they make things much worse. Now, before I go to the rock star that is Don, I want to remind all the listeners that when we buy a stock for clients, we buy it for Don, me, my 92-year-old mother, and our families. Okay, because at the exact same price, at the exact same timestamp. So we eat our own cooking. So the question is, how do you participate with your money in growth stocks to give you enough return, but not get creamed during bear markets and making your pie chart set it and forget it portfolio random? Don't let your portfolio be random. Okay? So when you listen to these guys right now, I don't want to beat this too much, but when you listen to these guys, does your advisor sound like that, or is he asking you for a tea time? Don doesn't play golf, okay? During market hours, Don won't even talk to you. You got to go through me, okay? He's in front of the computer. Always 2 or 3 guys are in front of the computer when the market's open, okay? All right. So in the words of, I built you up pretty good, Don. So in the words of Paul, don't let me down. So with that, I give you shareholder and senior portfolio manager Don Vandenbord and the team that Don built. Don, don't let me down.
I am most definitely not a rock star. I'm not aware of any groupies at all, Dan. And I've watched enough rock and roll shows to know that there's always groupies, and I just don't have them. So we're not going to go down that path. And if there's four of us pinned to the screens every day, and there was four of us watching what was going on Monday morning, and it truly was a black swan for one sector. As Dan mentioned, and if you follow us on the videos, there was absolutely nothing wrong with the market at close of business on Friday. In fact, we were up 8 out of 9 days. And then there started to get more traction, started late afternoon Friday, and hit the media over the weekend about this Deepseek that caused a deep red reaction to, I've got a list of 33 names here that are tied to AI and AI data centers. So coming into Monday morning, first of all, I learned back in Q3 or Q1 of 2021 to never be concentrated in all growth leaders. We had a great 2020. You could have thrown a dart and made money in 2020. We had a fantastic year, but it turned on its head in the middle of February of 2021, and we pulled back more than we expected to. So what do? We're problem solvers here. We're technicians. We dug into the data, made some changes, and as a result, we set aside 50% of the portfolio into the S&P 500 or other index ETFs to smooth the equity curve. And if we hadn't had that half of our money in that Monday morning, we'd have been down double what we ended up being down. But coming into Monday morning, we were 80% invested, had 20% cash. Half of that was in S&P and NASDAQ ETFs. A third of that was in gold and Bitcoin stocks. And the rest of that was in 10 individual names. 7 of those names were tied in one way, shape, or form to the AI data center. We had 10% into semiconductors and 9% into infrastructure plays. And they all got hit. They all gapped down. The market gapped down 2.2% at the open. I'm talking about the S&P 500. Our portfolio gapped down 4.5%. So before you could even react to it, we could tell that these names were getting hit. So then the question is, does it put in a quick bottom, or is it going to be an overreaction and bounce? So immediately what we start doing is selling a piece, because we don't really know how it's going to go. We can always stop the selling if we get a strong bounce. If it continues to the downside, we'll just continue selling on our way out. It's more of a kind of like a TWAP, a time-weighted average of exiting. Right. By the end of the day, we were down a little bit over 5%. The market bounced somewhat, closed down 1.5%. And what we saw was money flowing out of all these names and into value names. So on that day, the growth half of the S&P 500 was down 3%. The value half was up 1%. So again, that's another one of the lessons that we learned back in 2021 is to, when that rotation takes place, you can catch it. You can catch part of it by being in the S&P 500, and it certainly smoothed the equity curve somewhat. As I said, we'd have been down more than we wanted to. The biggest flaw for us was that, we talk about our balance at risk, but blowing through those stops at the gap down open is going to make us take a closer look at how much of a fluff factor or a fudge factor we need to build into the calculation of stops to account for these downside gaps. We know there's always a possibility of them. Yeah. We always know there's a possibility of it happening, and that's going to be, we're gathering the data and we're going to have our data scientists take a look at it, but we'll be adding a certain percentage to our balance at risk calculation to account for slippage, which there was more of it than we certainly wanted to. For example, if we thought our balance at risk was 5%, but it's actually 8%, that's still losing 8% of your portfolio is very easy to come back from. And that ended up being the situation that we're in. But if you think you're losing 5% and you actually have 8% at risk, we want to tighten that up. And that's what we're working on right now. So we got stopped out of 7 positions. And we saw a big rotation into not only value type names on Monday, but also money coming out of semiconductors, and these infrastructure names went into some software names. So we got A lot of stocks held up just fine. We redid the 21 over 21. I had half of the stocks dropped out, and I had more than enough candidates to fill it back up without question. So not everything was damaged. The indexes looked fine. You're looking at the S&P 500 here, and yeah, it was a gap down, undercut and reclaimed the 21 and the 50-day moving average, but bounced back above it and closed back above that 6,000 level, which has been providing support. So from a broad perspective, that part of the portfolio worked. From a focus perspective of being in the best stocks in the best sectors, that was a failure. But you also have to account for all the gains that we made in those leading stocks going up throughout, starting with the follow-through day in November of 2023. So a lot of it was gains that were being given back. And we also don't plunge immediately when new money comes in. We go in a very measured manner, going to the indexes first and then tiptoeing into the individual names that we're gonna own. So that minimized the downside somewhat for new client money that was coming in.
Yeah, we don't assimilate right away.
Yeah. So very tough day. The toughest in Revere history. We were down more in mid-February in one day of 2021. That recovered by the end of the day. This one didn't recover in these particular names. Now they've bounced over the last 3 sessions. In fact, 2 of them that we hadn't owned that didn't break down and the charts held up the best, we initiated small positions in them today because as of right now, it's looking, and we kind of knew that this was going to happen. I said in the video, it seems like a massive overreaction. This one action by a Chinese LLM model that they say was developed for much less than the big tech models.
Right.
There's a lot of people have poked holes in it since. There's no question that the end product itself is solid. How they got to that end product is
how
questionable.
Much energy it takes. Yeah.
Well, but not only that, there's something called distillation. It's when one AI model is using the output of prior AI models to reduce its training.
Right.
It's very complex. I've learned a lot more about the ins and outs of it over the last week, but every day somebody comes out and pokes a hole in it. And what we've seen, we also knew that earnings coming out this week that had a lot of impact on the AI data center names. Were they talking about any slowdown in their spend? Meta didn't. Microsoft said it expected to spend less in 2026 than it did in 2025. But Celestica, CLS, an electronic component company for building out these data centers, beat and raised and is up 15% today. Those are the types of clues that we're looking at. How are these companies actually reporting earnings? You're not going to get somebody completely pulling the plug on their AI plan because of this one model coming out. In fact, you're going to get more companies interested in doing it because now it appears they can do it cheaper than they wanted to. So, we're going one day at a time. We've recovered, some of the losses over the last 3 days, and we'll just continue to put our best foot forward, tweak our process a little bit, make sure that our balance at risk is a more accurate reflection of overshooting to the downside, but you don't want to completely overhaul your process because of one bad day. Not denying that the day didn't happen, but there's always takeaways. There's always lessons learned from instances like this that happen.
Well, hang on. So folks, here's the bottom line. When we were talking about as part of investing in what you can manage and what you can't, right? Gap downs and gap ups, because a lot of them they're more gap ups than there are gap downs, or they're probably whatever. But I mean, you've got a lot of gap ups too. That's what people don't. Nobody.
Yeah, but you don't have 33 stocks gapping up 20% on something that happens. That doesn't happen.
Yeah, fair enough. You'll have individual stocks gap up like that. But all I'm saying is you can have a market where it pops up 3% or 2.5% if you have good enough NASDAQ news or whatever. But here's what I'm saying. To be able to make, now we always constantly we're constantly trying to fine tune it and make it better and better and sharper and try to refine it. And we will do that. But up to this point, I've done research for years on how to minimize gap down losses. And what I've determined thus far, we're still looking at better ways to do it, because the pairs trade can get you double whammied. The pairs trade doesn't work that well. It really is not that great, right? Is that you got to be able to put up with some amount of gap down. Now, here's the good news. If it continues, we get out. In other words, one gap down day is not going to kill your portfolio. It's not. Okay. If you start getting a couple gap down days in a row, they're called distribution days, and all of a sudden you get a whole bunch of them in a row, that starts precluding a bear market because selling begets selling and volume kicks in, and then we would be completely flat. That's why, so you can have single digit ups and downs in flows, but you're going to have to be able to put up with a little bit of volatility. Otherwise, you got to do one of those index things that can never lose money, but it also can't make that much because it's capped. So you're going to have to deal with some amount of money. Now, here's what I can tell you. Grotection's made double-digit returns trailing 5 years. Last year, we beat the S&P, and we've never had a bear market, ever. So in any event, it's a smoother ride. And if you're trying to look for 9, 10, 11, 12% returns, not 7, that's what it is. And I would say, based on drawdown, my simple mind, how much money did I lose? We're much less risky than the S&P 500. Based on drawdown. And I've got the data to prove it. All right, Don, let's hear what the team's got.
Well, first, I have up on my screen right now, this is the best in hindsight, the best hindsight hedge coming into Monday would have been to own SOX S,
right,
which is a 3 times inverse semiconductors. And if we'd have owned something like this gapped up 17%. So even if we'd have had a 10% position on this, that would have offset a third of the losses. But that, first of all, is a big position to have in a 3 times inverse ETF. If you had good news coming out on semiconductors over the weekend, this could have gapped down, maybe not this much, but it eats into your returns. And like you said, Dan,
you got to be clairvoyant.
We've done into this,
you got to be clairvoyant.
You can't,
you got to be clairvoyant.
We have to be realistic about the expectations.
The only way to avoid gaps really well is to pay a lot of money for insurance, aka now you got the buffered annuity that's 7%. That's what that is. That's why you get that. If you can't put up with any if you're so wimpy you can't put up with any fluctuation at all, then go do a buffered do those buffered ETFs. I wouldn't even do the annuity. I'd just do the buffered ETFs. But if you need more than that, if 6-7% is not enough, reach out. All right, Don.
All right, so let's talk to the team first, and we're going to start with Todd. Now, we've talked a lot about how Dan, you and I seeded Ted and Connor in portfolios, and how well they did with that test portfolio, and we ended up to where we're rolling out TurboTection to very aggressive or accredited or very young investors.
Sophisticated,
and with Todd. Yeah, with Todd coming on board, he's got his specialty over the years has been taking bigger positions, more traditional can slim, fewer positions, but larger positions. And we've seeded him and he's actually, some of his clients that came over are in this portfolio also. It's very aggressive. We're not rolling it out to the general population yet, but some of my money's in there as well. I like the way he trades, and he's going to talk about one of the buys he did in there, a solar stock. And the first thing somebody's going to say is, why are you buying a solar stock? And we're on record about this. Sometimes if you look at the index at an ETF that represents a sector, it can look like garbage, but at the same time, you can have some stocks that are absolutely standing out in there that might be the leaders if you even get some semblance of a bid in that sector. We recently highlighted this with AEM, which is a gold stock that has been put on the 21 over 21 list. This good setup here got our attention. Then we went and looked at GDX, which we do every day, and that really didn't look that well. But it's certainly improved since then, and we've got a position in Nugget. And AEM was the one that really pointed us to that sector. And there may not be something that goes on, and this goes a little bit against the rules that say focus on only the leading sectors. But sometimes there's a stock that can lead the sector, as opposed to and then you always have the laggards in the sector as well. But NXT is the first one that Todd's going to talk about. So take it away, Todd.
All right. Before I start, I'd like to wish Dan a happy birthday. I had no idea it was his birthday, so happy birthday, Dan.
Thank you, Todd.
All right, the first stock I'm going to talk about, or actually the only stock I'm going to talk about today, is Next Tracker. It's a position I took yesterday. I started accumulating it in the pre-market. Monday night, they reported earnings. And you can see this is a pretty choppy stock. It was a new IPO back in February of 2023. We like new IPOs and we track them because they can often become new merchandise. This one in particular has really had a very choppy past, but I've been following it for quite a long time, and it has had a few earnings gap ups throughout the last 4 prior quarters. And today's earnings gap will make it 4 out of the last 5 quarters that it had some type of gap. However, it's never really been able to follow through in the past, despite having several beat and raise quarters. Now, in this particular example, we see market surge shows a double bottom base in development prior to the earnings report on Monday night. So let me tell you what they reported. They had earnings of $1.03, and they were looking for 58 cents a share. So that's a 78% beat. Right away, that has my interest, okay? The second major thing that they reported is a record backlog, which they said is significantly greater than 4.5 billion. Significantly greater. Okay, I don't know what that means, whether it's 5 billion or 8 billion. But, I'm looking at the company, and at that time, they only had a $6 billion market cap. So already you have a backlog that's as large as the market cap of this company almost. Okay. And then they guided fiscal year 25 earnings of 375 to 395 when they were looking for 327. So they're guiding nicely for the fiscal year. So right away, this thing's trading up 18-20% in the pre-market on those earnings. So I like these plays, and I started with a 3% position in the pre-market at 49.73. Okay. And then that's just a starter position. If the stock wasn't acting well and reversed, I would just sell that for a loss and move on. It did retrace a little bit during the day, but I really want to focus on how the stock closed on that gap up day and what were the characteristics. And the important thing here to note, this stock was up over 24% a day with an increase in volume of 370%. Okay. Now, Jason Thompson and John, the Rain King. What's John's last name? Do you know, Dan?
Pocoroba.
Don?
Pocoroba.
Okay. If anybody would like to take a look at it, they came out with an excellent study on earnings gaps and the statistics behind them. And they code this as what is called a monster gap. Okay. And a monster gap has to be at least 20% higher on the day. Volume must be at least 300% higher. And with a monster gap, there's no requirements of prior fundamentals. So you don't need earnings acceleration. You don't need strong sales growth. In their study, that had no correlation to how monster gap ups perform. Basically, they're so mispriced and there's something going on with them that fundamental side is irrelevant. Okay. Now, this is in a group, solar, which is a very poor performer. And most solar stocks have done absolutely terribly. But if you look at the new electricity capacity that's been added over the last year in 2024, their CEO says 60% of it came from solar. Now, when I go on Perplexity, Perplexity's saying 83% of all new solar capacity or all new electricity capacity came from solar. So, despite what people think of solar, it's providing most of the increase, at least through last year, of what the new electric capacity came online in the US. Okay, so there are some good things happening. And all this is at the utility level. So, really, the big thing here, the utilities are really buying Nextracker's technology. These are the bases that track and move the panels as the sun goes across the sky in different directions. They have software that's included with this to run these arrays, and that's a very interesting area. So on the earnings gap day, this thing closed in the upper 80% of its daily range, and that's a very positive attribute. And this morning, when it went and broke yesterday's high, I added more of the position, and I also added more of that position on the close too. And currently, that's a 10% position. So what I'm going to look to do here is I will use a 5% stop loss from yesterday's closing level, and that will be where my stop loss is set on this position. And that's it.
Good stuff, Todd. This is showing exactly the behavior that you want it to, making the second day higher high on well above average volume on the second day as well, and clearing some very critical resistance over here from July of last year, as well as that half Livermore level at 50. If this should start to pull back, we should expect 50 to provide some support on that. So shout out to JT and John. That gap course is excellent. We've taken it and implement a lot of the criteria into our process.
And by
Thanks,
the way,
Todd.
And by the way, this is, people tell you you want to buy low and sell high, and you want to bottom fish, folks. That's buying junk off the bottom. A lot of times it'll take 3 or 4 years for the investors to recognize if there's value there. It's junk. It is junk off the bottom. That's why it's low. It earned that price. So these stocks, price is truth. They're coming up like that. You would be told, oh, you can't buy. Bill O'Neill's famous quote was buy high and sell higher. So you actually want to buy stocks that are moving up. You don't want to bottom fish. That's counterintuitive. Okay, done.
All right, let's go to Ted next. He's going to talk about some of the rotation from semiconductors into software. Take it away, Ted.
Yep. So just continuing the theme of the massive gap down that Don and Dan talked about. We also saw a potential sea change in sector rotation as well. January 27th, this Monday, was the key date. And I'm going to provide you guys 4 names in the semiconductor area, or as well as the ETF, and then 4 software names that you can see saw some inflows on January. And Dan and Don pretty much already gave the background of Deepseek, how it matches the OpenAI O1 model, but they did it cheaper. But then there's some controversy behind it, whether they stole some of the intellectual property of OpenAI, but we won't dig down that rabbit hole. The fact is that price changed and we reacted, and we're seeing a shift in rotation here. So first name, SOX. Yep. We gapped down pretty much in the stage four. Of course, we've talked about stage analysis numerous times on the podcast. So hopefully you guys are familiar with that by now. You can see the 200-day moving average is flat and it's starting to turn down. Don, can you go on a weekly? Just to give a better picture of the cycles that we are looking at. Yeah, perfect. So as you can see, the 2 moving averages that we key in on for stage analysis to determine whether a stock is in a basing period, in a topping period, uptrend or downtrend, is a 30 and 40 week moving averages. Semis, since the bottom of 2022, emerged into stage 2. You can see the 30, which is the magenta line or the purple line, and the 40, which is the black line, started trending up. Price was above those. So you can classify that as an uptrend. And then we had a huge, sharp sell-off. And if I see that properly, that is around September 2024. We broke the 10 and 20, which is the red and the green lines, all the way down through the 30 and the 40. And once that happens in the stage 2, you can pull back a bit, and you can kind of see that as distribution and potential entrance into stage 3. And so far, that seems like that's what we've gotten. And multiple rejections at the 10-week red line so far in the last 3-4 months. And recently, we tried to poke our heads above and then just got slammed back into stage 4. You can see that volume bar at the bottom, super high volume above average. Looks like to be a 2x above average volume almost. So definitely some huge red flags here. The RS line has been trending down for the last 7-8 months as well. And that RS rating is 37. So definitely a lot of weakness in these semis names, despite how bullish AI and the build out AI has been. So just quickly, three names in the semiconductor sector. NVIDIA also broke down into stage 4 itself. And something really notable for NVIDIA is it's the first close below the 200-day and 150-day moving average since the start of this bull market, which pretty much started late 22, early 2023. And that was the last time NVIDIA was like below the 150 and 200. So, and we're here to judge the character of stocks, and this is a clear character change. No matter what anyone says, whether Deepseek is a fraud or not, price is telling us what is happening, and there's massive distribution in NVIDIA now. You can see that volume candle. This week's volume candle is some of the largest in this entire move up, and especially in recent time. So definitely taking the red flag there, and we're quite unfavorable on the semiconductors so far, or as of now. 2 other ones that got blasted too, and we actually owned one of them. First one's Marvell. Actually, we'll go with Avgo first. So yeah, this one, same sector, got destroyed below the 50-day. It could barely rally right now. So that just tells you everything you need to know. Just extreme weakness. We're below the gap days low as well, and yeah, definitely not looking good here. And the last one, we owned this, and we kicked it out quite quickly on the gap down day, is Marvell. And similar action here. We gapped up on earnings a few months ago, and then we're trading pretty much near 52-week highs, where that actually might be all-time highs, but I don't have a view of the left side of the chart going back. But there's literally nothing wrong heading into the weekend. Just really an inside day, tight day above the 8 EMA, and then the proliferation of the news articles on CNBC and other news outlets about Deepseek caused major fear in the markets, and people just dumped semis as a whole. On the flip side, January 27th marked an important day for software names. And we've seen Jensen Huang, CEO of NVIDIA, talk about the CES event, the arc of AI build out. And it starts with generative AI, which are all these LLMs, ChatGPT, Grok, Cloud, DeepSeek is another one. And then the next phase that they talk about is agentic AI. And a lot of that agentic AI will happen in these software names. And then finally is physical AI, which we won't talk about today, but something like Tesla with its humanoid robots and robo-taxis is what is classified under physical AI. Something like ISRG as well with their medical robot. But let's talk about software. First one, Twilio, a standout name in software. It pre-released earnings, and that led to its second gap after its first earnings gap. Just wonderful move recently, extremely strong, trending linearly above key moving averages. And even on that market weakness, January 27th, it held up well. And so far, it's continuing to trend higher and making new highs. The next one is Palantir. You can also see that on that January 27th day, this past Monday, or just this Monday, it closed near highs of the day. When the pressure lifted off from the fears, the overall fears, we're pretty much back almost into new all-time highs.
Would that
Third
be
one?
would that be considered a handle right there? Is that not well enough form to that you've got a cup that's kind of a V, but
yeah, it's starting to form a handle here. But since it's V-shaped with earnings coming up next Monday,
yeah,
we'll see what happens. And then a cybersecurity name, and is Crowd that I want to share as well. And it just had clear strength that January 27th day. It broke out. I believe I'm looking at the right day. And so far, it's just retesting the highs, previous all-time highs and the handle highs. So this looks great too. I want to slide in a name that I didn't tell Don before the show, but Don, can you bring up RBRK? It's also another cybersecurity name, and we own this in Turbo, actually, for full disclosure. And yeah, cyber is definitely an area I personally think is really bullish, especially this huge push into more data. AI is all about data. We need security on our data. Even if we enter recession, companies aren't going to cut back on their cybersecurity. That'd be quite ridiculous if they did so. So these are, in a way, quote unquote, recession-proof stocks. Obviously, they still probably will go down in a bear market, but everyone needs cybersecurity nowadays. And then finally, Net is a huge standout as well and continues to make new highs, trending perfectly above its key moving averages and showing strength. You can see that one day, this past Monday, I think it undercut and reclaimed the 8 EMA, if I see that properly. And then the next day lasted into new highs, and we have earnings soon as well.
Yeah, what you saw a lot of on Tuesday with these names, if you look at a 5-minute chart, is that they all gapped down with the market, and then immediately you saw money flowing into the software names within the first hour and a half, while the money was coming out of the semiconductor names,
Right.
and then followed through strength on Wednesday, Thursday, and Friday. So good stuff there. All right, Ted, thanks.
And by the way, Don, and by the way, that's a great point. So when the market starts rotating out of the AI stocks, we get defensive because we don't know if it's going to keep going down or whether it's going to hold. And then rotation starts happening somewhere else. We start picking up some of those other names. So you're rotating into the strongest areas. Remember last week I talked about managing risk with relative strength and rotating to the areas that are strong. You may get stung once in a while, like last Monday, but time in, time out, you're going to win those hands. You're going to win over and over because you're playing the probabilities, and over time, you're going to do great without the big drawdowns. All right, Don, sorry.
All right, Connor's going to wrap it up with a pattern we don't talk about a whole lot, but one that's we look at everything and are always trying to improve, and we're going to start off with something we owned and made nice returns on earlier last year. And then it topped, is forming a base, and I'm talking about CAVA.
Yep. Thanks, Don. Yeah, so if you follow Neil and stuff, the 3 weeks tight pattern, that's talked about a decent amount, but it's often talked about when the stock, makes a big advance and then it puts in like a 3 weeks tight in the upper end of the range. And that's like, if the stock's breaking out and continuing to the upside. But one thing that I've tended to notice is that the 3 weeks tight at the low end of the base also frequently pops up. And, I don't really hear too many people talk about this. And CAVA was the first stock that I noticed this pattern on recently. And as you can see, what I notice in this pattern is it's for stocks that have made large advances, so very fundamental, sound companies that have made huge, big moves. And then obviously, a stock can't just go up in a straight line forever. It's very healthy to have basing periods, pullbacks, and that's when the stock enters the relative weakness phase, and it's not necessarily doing anything wrong. So CAVA obviously topped around that prior earnings report, and by that time we were out of it, but we still watch the stock. The story never changed, just the price did, and that's why we got out. But you can see that's some clear sell signals. That was kind of like a climax top, and that had a harsh break of the 50-day moving average. So it started to pull back in base, and that 200-day finally caught up to price. And one thing when a stock pulls back is institutions, they don't buy breakouts. They're the ones that make the bottoms. And so you can see it worked off all that extension, and then it actually held the gap day lows right there. And then it started to curl back up. And this is when you started seeing that 3 weeks tight pattern show up on the weekly, which coincided with the 40-week moving average. And, again, to me, that tells me, big pension funds, mutual funds, big institutions, that's the place to buy if they missed the initial run. And after it triggered that 3 weeks tight, it continued to pop up. And now it had a nice break back above the 50-day moving average. And this one looks a lot better, back in a relative strength phase as well. And this was this happened while those Deepseek AI data center stocks got crushed. Money was flowing into here, and that kind of started a couple weeks back. And now it's in the relative strength phase. So definitely one to watch. But that was a really good example. And then another example that's from last year is Tesla. And this was in, the May, June area. And if you go to the weekly chart, obviously everyone knows, Tesla had a very rough couple years, and you can see where Don's got the arrow. That was the first change in character in the whole downtrend, and it got extremely tight there. Obviously, there was still a lot of moving average overhead. There was a lot of supply, but to see it start get super tight and build a higher low after kind of that shakeout in the previous week, that was maybe a sign that people were starting to buy this one again, and it could be close to a bottom. And sure enough, the following earnings report, it had a really strong turnaround, gapped up on big volume, kind of came back in, had just some natural shake and bakes, volatile action when something is so far off highs, and then got prompted up again on another positive earnings report, along with Trump getting elected. And then now this is trading much linear, and it's above all-time highs, or right under all-time highs, and it's acting well. It just had earnings today, and it's coming back pretty strongly. So that's Tesla. A third example is GE. And again, this one had a very similar roadmap. The story with this stock was a stock that not many people probably followed or expected it to have this big of a move, but this one had another huge run off the lows, and then it entered into a phase of relative weakness. And then you can see right at the 40-week moving average, it started to get tight. It put in a 3 weeks tight formation, and now it's into new highs. So, we're not really bottom fishers here at Revere, but I think this is when you look at a chart like this and you see the 3 weeks tight at a certain moving average when it's in a prior uptrend, that can be an edge. And then again, if you own a stock from much lower and you're trying to hold for a big move, and it pulls back to the 40-week, and you're using a wider stop loss because you have so much cushion, that could also signal a potential ad spot, or just allow you to keep yourself in if you've been holding a stock for a couple months to a couple years. So yeah, that's the perspective on the 3 weeks tight, but in the bottom of the base.
Good stuff. Something, if nothing else, we used to, a couple of years ago, I did I featured on one of the podcasts, I talked about Titans at the 200, and really we look at them more for if the market is in a complete pullback, what's finding support at the 200-day moving average, assuming that the averages have already broken. These stocks should stand out to you, but it also applies to stocks that have had prior big uptrends and they're just taking a rest. And like Connor said, the institutions love to buy value, and this 200-day / 40-week moving average is very often a spot where you will see, look at the heavy volume coming in on the way down, but when did it stop? When it undercut and then reclaimed the 200-day moving average. Some volume came in, went sideways for a little while, and then broke out of this nice flat base on its last earnings report, had a normal pullback, broke the low of the gap up day, which we don't like to see, but it found support at the pivot of this flat base and the 8-day moving average, and is trying to regain. In fact, it's above the close of the gap up day right now. So good stuff, Connor. Some interesting and a little bit different stuff to take a look at this week, Dan. And we're always keeping it interesting here at Revere. You can go ahead and take us on home.
All right. Well, thank you, Don. And folks, listen, this is why it's important. We've been talking a while ago about NVIDIA. If NVIDIA and a few of the AI stocks crack, the whole market could go. And because they are a lion's share of the returns last year. You take NVIDIA out the last couple of years, the S&P wasn't all that great. NVIDIA was a huge piece of that. A couple other stocks too. But here's the thing. If that deep I was going to say deep fake, Deepseek stock. Well, we don't know whether it's a deep fake or Deepseek. Oh, that's good. I got to use that yet. But if it turns out to have momentum, so the scare was when that story came out, those stocks got clobbered, and growth portfolios were hit hard, right? Well, if that story turns out to have legs and be true, and they find out that it actually is very efficient and is better, these valuations of these companies and these AI build-outs are way overvalued, and they could lose a third or even a half of their value, right? So remember, leading stocks, the best of the best, sell off 72% from their high. So Tesla was the best performing stock in 2021. In 2022, it lost 69%. And then in 2023, it opened up the gate. It was one of the worst performers for a while. Now it's one of the best performers again. That's why you can't buy and hold. You pull up a Tesla chart, you're just spinning your wheels. That's why you got to get in it sometimes and you got to get out it sometimes. And you can manage your risk and you can manage your drawdowns. So you don't have a pie charts or us portfolio turning your retirement, your money, into randomness. If you want your money to look exactly like Don and my money, join the Revere family. You can just go up to revereasset.com. Up in the right-hand corner, there's a subscribe button. Put in your name and email address, hit subscribe, and you'll get our daily market insight. Every night the market's open, we put a daily a video out, 10-minute video telling you what the market's doing and what we're actually doing in client portfolios. We're the most transparent advisor, not only in the country, in the world that I'm aware of, right? And then next to that, there's a contact us button. You can say, please give me a complimentary portfolio review. If you want a stock or a topic you want talked about on the show, we'll talk about it. We talk about everything, the good and bad, losses and gains. We're completely transparent. You can also always call me old school at 855 Real Wealth. Folks, we'll talk to you next week on your money, not Wall Street's money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.